our Facing the Risk, Recognizing and Mitigating Risk in Latin America webinar, featuring Nate Zapaya, founder and managing editor of Alternative Latin Investor. We will begin the webinar shortly as we wait for a few more to join us. Hello and welcome everyone. Thank you for joining us on the webinar today. My name is Kristen Stiegel and I manage events here at Axial Market. We are thrilled to be hosting this webinar today in collaboration with Alternative Latin Investor. Before we begin the presentation, I'd like to give a quick overview of Axial Market and an introduction of our panelists. Please feel free to send us any questions that arise throughout the course of the webinar via your chat box, and we will answer them. We'll also leave time at the end of the presentation for additional questions. For those of you not familiar with Axial Market, we are a network of over 9,000 accredited and active deal professionals. We help connect all types of private market participants around live and relevant transactions. Examples of our members include investment banks, private equity firms, lenders, corporate development offices, and high net worth individuals. Our goal is to facilitate new relationship building, more easily manage existing relationships, and ultimately close more deals faster. The marketing organization here at Axial Market focuses on providing relevant and informative content to investment and deal professionals in the private capital market space. We do this through hosting events, webinars such as this, and regularly publishing reports and articles on our blog. We are looking forward to a very robust pipeline of events in 2013. For today's webinar on Facing the Risk, How to Recognize and Mitigate Risk in Latin America, we are happy to have founder and managing editor of Alternative Latin Investor, Nate Zapaya. Nate began his career as a wilderness paramedic in Montana, studying pre-med and turned to economics after covering China's acceptance into the World Trade Organization for The Economist at their Beijing office. He graduated with a degree in finance from the University of Loyola Chicago, then worked in the Chicago office of Oppenheimer as an associate broker. After moving back to China, he worked as a management consultant for a German firm specializing in strategic entry analysis and due diligence. In 2007, he relocated to Buenos Aires and started various publications in addition to the Capricorn Research Group, providing comprehensive reports on Latin America's wealth market. In 2009, he launched the publication Alternative Latin Investor, which has quickly grown to be the top source for information on alternative investments in Latin America. Nate holds a master's from the University of Buenos Aires in International Economic Relations and a master's from the University of Bologna in Development, Innovation, and Change. We're excited to have Nate with us today. So with that, we'll jump right into things. What information are you currently using to assess risk?
Well, it's really interesting when you look at risk because there's a lot of information out there, and much of the information comes from obviously from news media, and this information isn't targeted at investors, or it's general information for the people interested in news. So if you look at on the slide, this is the Fund for Peace's Failed States Index, and this shows government corruption, lack of infrastructure, so on and so forth, and most of it is kind of orange. Which is on the bad side of risk. However, if you look at the numbers, in 2012, 70% in 2012 of GDP growth came from emerging markets, which means 70% of all GDP growth last year came from most of these orange states. So that, despite the fact that they look risky, it looks dangerous, that's where the growth is coming from. So it's kind of a case of causation without correlation. I know in statistics they give you the example, if there's bad traffic and because it's raining, umbrella sales will go up because it's also raining. So you can make the correlation that umbrella sales cause bad traffic. So that's just kind of those causation without correlation things that can happen in investment. You see something that looks risky, you see a nationalization, you see a leftist president get elected, and you automatically assume the worst. However, that's not always the case. If you look at, like the Pinochet dictatorship in Chile, revolutionized the country. If you look at, the Lula party in Brazil, it was somewhat leftist, but in Brazil is doing fantastic, so on and so forth. So it's really, you have to decide what information is relevant to what you're actually doing. There's also a situation with perceived risk. For example, the Peruvian election in which President Humala was elected, investors were very, very excited about Peru before he was elected. People were piling money into it. It's a huge mining country. There's huge expansion. They're building a new central business district in Lima. There's a couple hedge funds popping up, private equity funds. Very, very exciting place to be. As soon as Humala got elected, who had a leftist attitude, investors pulled back. And there was an opportunity created, kind of a vacuum from them, because they ran away so fast. But in actuality, nothing really bad happened. He wanted to give a little more share to the miners. There was still a great opportunity. He didn't go as far as Chavez or as far as Castro or some of the other countries. So the perceived risk can actually create opportunities because there was a huge vacuum within Peru, within 6 months after the election to a year after the election, and that could have been filled by some savvy investors. So risk can work both ways. It can work in your favor, and it can also work against you, depending on which side of the fence you lie. And then also, if we look at other kind of statistics in terms of information, you want to look at it kind of a bottom-up approach when looking at emerging markets as opposed to a top-down approach. A top-down approach, for people new to the concept, is when you look at macroeconomic factors and then dial down to a company. When you're looking at a bottom-up approach, you're looking at the company factors and you're kind of going up. In emerging markets, it's many companies, firms can operate just perfectly fine, despite the bottom-down risk. For example, a colleague of mine was working in Egypt during the Arab Spring, and things were fine in terms of business, a political disaster. So these perceived risks can actually scare away many investors when things are actually fairly stable. Also, if you look at Argentina, Venezuela as investable countries in Latin America, they get a lot of press for being super risky. Cristina Kirchner nationalized YPF Repsol. She's got found with suitcases of money in Miami. Chavez nationalized everything, so on and so forth. But if you look at the actual numbers, of all corporate debt in Latin America, Venezuela and Argentina account for less than 5%. It's not even really a blip on the radar. While it gets a lot of press and it makes the entire region seem risky, it really has very little relevance to anything. So that was that.
So then, what factors are considered risky if so much of what you just mentioned is kind of just a perceived risk?
So basically, the perceived risk is, basically what most people get in terms of news. They get, a headline from New York Times, from Financial Times, so on and so forth. But the real risks are kind of the more direct risks, like currency risk, and then political risk. It can be risky depending on where you're going. And then, currency risk, economic risk, market risk. Those are the top ones that you have to look out for. And also, there's just operational risk. I find is a huge one that most people overlook. It's not really talked about much. But when you're going into these countries, the actual operation and running of an investment is quite risky. You have to see, can you get, the two most important questions are, do you trust the people looking at taking care of your money? And can you get your money out? So, that's why we'll talk about this a bit later, but we stress, local partners and due diligence in knowing what the operational risk of your investment will be. Obviously, if you just give, if you give BlackRock, LatAm Fund some money, you're fine. There's not a lot of risk involved in that. It's based in the U.S., so on and so forth. But if you're doing more alternative asset deals, if you're doing foreign direct investment, dealing with local funds, the risk does increase substantially.
How do I tell then, Nate, if the information that I'm looking at is actually relevant?
Because you have to use the information to know if the information is relevant. It goes back to our first point in determining what kind of an investor you are. So if you are decided that you are a very low risk investor and you're putting money into a pan Latin American fund, then there's the risk that's in the newspapers isn't really relevant. If you're going to buy a vineyard in Argentina, then that risk is relevant. You have to see what are the property rights of Argentina. How can you get money in and out of Argentina? What's the likelihood that they might take your land, so on and so forth. So there's no real way to just say what is risky and what isn't risky. It's very specific to the investor and the specific investment.
Thanks. So moving on, as in all investments, the numbers seem to be king. So what are the numbers currently telling you right now, Nate?
Well, the numbers in general are very much in favor of emerging markets and Latin America. I kind of have a theory that Asia, in terms of alternative assets, is kind of the past, with Singapore and Hong Kong being, such stable financial centers. Latin America being kind of the present, with lots of structural development, infrastructure development, regulatory development, and Africa is kind of the future. So right now is the time for Latin America, in my personal opinion. Like as I mentioned earlier, last year 70% of GDP came from emerging markets. If you look at emerging market Latin American corporate debt in terms of being not risky, in the year 2000, under 40% of corporate debt in Latin America and emerging markets was investment grade. Now over 60% is. So it's both growing rapidly and becoming more stable. So let's see what else. Yes. So the trend towards emerging markets is growing also for another factor. One is because the growth is just so outpacing the developed world. Like the U.S. and Europe grew 1-ish% last year. Latin America grew 5%. So the growth is going at such a rate that it's going to become a factor in investment over the next 10 years. Also, we see that lots of previously debtor countries are becoming creditor countries. So they're overtaking the developed world in terms of their fiscal positions. There's also a lot of movements towards what they're calling South-to-South investment. So last year, China overtook the U.S. as the #1 trade partner from Brazil. Brazil put a $2 billion private equity hedge fund into Africa for infrastructure development. And this is all cutting out the developed world. So the numbers are really trending towards a robust emerging market investment situation.
Thanks. So let's move on to combined risk. Are larger investment vehicles better, Nate? What is one's real exposure?
So that really depends on again, like to the core question of what is your goal out of this investment. So if you look at a pan-Latin American fund, there's lots of funds that are called Latin American this and that, and really the composition of those funds isn't pan-Latin American, is not pan-regional. It's mostly Brazil and Mexico. So those are the two exposures you're getting, despite buying into a Latin American fund. I would suggest to go to a Brazilian fund, a Mexican fund, or an Andean fund to really diversify outside of Brazil, which is becoming difficult, or which is becoming easier actually. Pardon me. Also, if you look at ETFs, there's kind of secondary exposure. So say you buy a Brazilian ETF. There's a huge commodity bias in these ETFs. And so if you're looking at commodities in Brazil, who buys those commodities? The people who buy commodities from Brazil is China. So if their #1 trade partner is China, and they're buying all the commodities, and the commodities are what are on the ETF, then you're really getting Chinese exposure. So that's kind of diluting your Latin exposure, and you're getting exposed to Asia. So when these kind of one-stop-fits-all solutions are presented, it's kind of like one-size-fits-all. They never really fit us that well. They kind of fit everyone poorly. So there is this idea of just an amalgamation of different things in one vehicle, which we don't think is particularly the best way to go. If you're very risk averse and you just want some diversification, they are great vehicles. If you just want to have that allocation to Latin America, you put money into a pan-LatAm fund. But your exposure is perhaps not what you're thinking you're getting. There's not going to be a pan-Latin American fund that's doing very many interesting things in other places outside the big places where they have their analysts, where they have office, so on and so forth. One of the nice things about the growth of Latin America is that every day, every week, every month, every year, we're seeing more and more products emerge in the Latin American market. We're seeing more and more different structures, vehicles, IPOs, so on and so forth. So say 5 years ago, there was not that many and perhaps zero kind of Andean funds, which Colombia, Peru. But now there's several. Now it's become easier to get outside of Brazil. Before there was no reason. When they had a 6% or 7% risk-free interest rate, they were just doing great. There was no reason to be anywhere but Brazil. Now with the Brazilian slowdown, Chinese slowdown, so on and so forth, getting outside the traditional regions is going to become important if you want to capitalize on Latin America and you want to maximize the efficiency of your portfolio.
Great. So how exactly does diversification help?
Well, I mean, diversification both in sectors and regions is always useful. I think when you look at, if you look at, I think statistically, if you have 39 equities in a portfolio, you have the lowest possible risk possible, just through math. So when you're looking at regionally, you want to diversify because of the main core of this presentation, which is risk. So if you have various risky propositions regionally by entering other markets, you are diversifying that risk. So Chile, for example, is very stable. The returns are lower, but very stable. If you have a part in Chile, that's an excellent part to kind of meter out and to smooth out your portfolio. Colombia, Peru, huge growth. They're growing at ridiculous numbers. Great to have part of the portfolio. There's some small things happening in Central America. Nicaragua has Intel factories. Panama has Trump Towers, so on and so forth. So they're growing at a ridiculous rate as well. Mexico is kind of almost is very undervalued, in my opinion. Again, when we come back to the risk, in the papers and the news, people are saying all about cartel violence, murders, drugs, this and that. But they really aren't affecting investment as much as people think they would. Also, there was a kind of a perceived risk after the October 2008 crisis, where because of the coupling with the U.S., people thought that Mexico was severely depressed. The economy was in the same state that ours was. However, that was not the case, and there's a lot of opportunities in Mexico. One, because of the perceived risk between cartel violence or coupling with the U.S., another just because of Latin American growth. There's amazing things happening in Mexico as well. So really, the story for the past year or two has been looking to not, delete, but to expand outside of Brazil. And also Brazil could kind of work as an investment overflow kind of situation where so much money came into Brazil, that was their introduction to the region. So now that they're in the region, it's easier to get outside of it. It's easier to look outside of it. But the problem is there's a lot of work involved in that because from my experience, Brazilian investors and Brazilian investment professionals are very country oriented. Because Brazil is just so large, has so much growth, has so much capital, so many people, people who work in Brazil are very, very Brazil centric. So it's hard to get advice how to get out of Brazil once you're in Brazil because they want to stay there. So once you're there or once you're looking outside, you really need to kind of talk to the people on the ground in these other regions as opposed to kind of using Brazil as a home base like you might Hong Kong or London or New York as a home base for investment because it is so Brazil centric. So moving outside is one of the things we're very excited about that's possible now because of these new vehicles and because of these new products.
Thanks. So taking into consideration everything that we've said thus far, what would you say, Nate, are the main risks of investments in Latin America?
So the main risk in Latin America really, I think, is depending on where you're going, is looking at logistical operational risk and then some political risk. But the political risk is minimal. I look at the operational risk as the biggest problem for investors going into the region. Because, and I don't put this really on the country, I put this more on the investor. People need to know what they're getting into. It's not easy if you're doing something larger than just putting money in a LATAM fund to get into Latin America or emerging markets. The reason they're emerging markets and they have such good returns is because they're difficult, is because there is corruption, is because there's not as much legislation around. So people need to understand that it's not just as easy as buying Apple on Scottrade. Entering the emerging markets is in itself a risk. It's going somewhere where they're getting better. I mean, they're getting much, much more secure. There's obviously lots of growth, but they still are emerging. They still don't have the regulation that Europe and the U.S. has. I mean, some countries are getting there, and they have very good regulation, Chile, Brazil, but getting in, knowing local partners, getting into the country and understanding what you're getting yourself into is a key to being successful in emerging markets. I mean, that's why there's been so much money made and lost in emerging markets over time, and why crises in emerging markets hit quite rapidly because so much money floods in and floods out. The 2001 stock crisis in Argentina, Morgan Stanley, Goldman Sachs was pouring money into it, flying investors down all the time to put investment in Argentina. They pulled out, and then things collapsed. So it is a risky proposition just entering emerging markets, but if you know what you're getting into, you can mitigate the risk by a huge amount. I think one of the largest problems is people assume that investing in an emerging market or investing in Latin America will be the same as investing that they've done in their local country or their home or in developed markets, and it's not. I mean, there's a lot of differences. There's cultural factors, there's operational factors, there's currency factors, and these all must be taken into account, and not just saying, I want to be in Brazil, how do I do that? There needs to be a lot more work done either by the investor themselves or the investment advisor on how to put someone in Latin America, why they want to be in Latin America, and what their goal is. Is it asset protection? Do they just want to not lose money in inflation? In that case, Latin America might not be the best place. Is it asset growth? Then it definitely is. What do they want to do? Do they want to grow their portfolio, grow their assets? Do they just want to diversify out of the dollar or the euro? What do they want to do with that? And once they understand what they want and they understand what they're getting into, I think the risk of investing in Latin America can be cut down by a substantial amount.
Great. And now the question we've been waiting for is, what are some key steps for mitigating these various risks?
So the key steps in mitigating risk are as you see in the slides, are first of all, as what we're discussing for the majority of this, is assessment. You need a plan of what you're going to do before you know what the risks are going to be. So once you have that risk profile, there are certain things you can do. So if you say, for example, you're looking at a private equity deal in Colombia. So first of all, you need to do your due diligence on the main factors. Political factors, currency factors, market factors, and security factors. So let's just take our fake private equity deal in Colombia. So politically, who's the current administration? Are they business friendly? Are they more than business friendly? Are they foreign investment friendly? Is the banking friendly? Can you transfer money in without a 10% chunk being taken out of it? More importantly, can you transfer money out? What is the possibility of them blocking your transfer out? I was in Cuba a few years ago, and there was a trade finance company who was doing trade finance in Havana, and Cuba, the Castro administration just put the kibosh on any external transfers of money. So they were making money, their investment was still there, they just couldn't get to it. That's kind of useless. So, seeing what the current administration is going to do, is the election coming up, is there going to be a future administration, what is their take on foreign investment in that country? Then look at the sector. Where's the sector going? Is the sector going in a good direction? Lots of, like, say, consumer sector and education are huge in Latin America now because of the growth of the middle class. So in Brazil, for example, there's 25 million people a year jumping tax brackets. So what's happening almost kind of socially as well to affect your investment. So we've got the political situation, the social situation, currency risk. What is the exchange rate? What is the rate of that going to be changed? How are bond prices affecting currency? Is it going to appreciate, depreciate? Do you want your investment denominated in US dollars, in local currency? Also very important to look at. Then look at the market. How is the market doing? How is previous year's GDP growth? How stable is it? How's the infrastructure? I mean, if you have this investment, if you're a private equity investment, can it be sustained by the skeleton of the country? And then the last one is security. And this one is relevant in many places in Latin America, but not all places. So, I mean, it's most relevant if you're looking at mining or the energy sector, because these are mostly in rural areas, and where rural areas there in certain, in Venezuela, Colombia, there is a military presence or a revolutionary presence. So that can be a factor as well. Also, if you look at Mexico City, there are some security issues, but this is really for only specific cases. So first of all, we've got our assessment. You know who you are, what you want, where you want to go. Then you do your due diligence on your political risk, your currency risk, your market risk, security risk, and your operational risk. How is this all going to work? Do you need to fly to your location every 6 months? Can you do it over the phone? Do you have to talk to anyone at all? What is your operational risk of being there? I mean, if you need to fly there every week and it's costing you $3,000 a ticket for whatever, it's not probably going to be that practical. So checking out your operational risk is also very important. And then obviously security. I mean, no one wants to have violence as part of their portfolio. So checking if that's going to affect you. If you are going into mining, you travel with security, or you don't have to directly be at the mining site, so on and so forth. So once you've done the due diligence on what you're actually going to be doing and how it gets done, local partners is very, very useful. You need someone who knows the market. You can understand the market through information, through media, through Alternative Latin Investor. However, there's people on the ground who really have their finger on the pulse, And that's not something you can get virtually. You can't get that online. You can't get that any other way through than being on the ground in these places, especially in emerging markets where things change so quickly. I mean, one day Spain owned 98% of Repsol, the next day they didn't. So, things can change very quickly. And if you don't have that finger on the pulse, or you're not connected somehow directly to what's going on in the country, you're already at a disadvantage and your risk goes up dramatically. However, on the flip side, you have to do your due diligence on these local partners. I mean, lots of, the bad press about emerging markets is because, unsavory characters, they prey on investors coming to emerging markets, Latin America, for the quick money, who don't do the due diligence, who don't know really what they're doing. They just want to be in this market because they've read the growth. So, having a local partner is important, but you also have to do your due diligence on them. Who's worked with them in the past? What is their education record? What's their track record if it's a fund manager? Have they had any problems legally? Has there been bankruptcy? So on and so forth. Just what you would do on any partner anywhere to make sure that you trust them with your money. I mean, you're giving them a large amount of money. You have to make sure that you trust them with it. So local partners is very, very important, but also you have to trust that local partner. And then, and then also, if you're looking, depending on what vehicle you're going into, you need to understand it. Investor sophistication has grown over time, and now with, ever since 2008, with the equity markets depression, people are getting very, very excited about alternative asset classes, which we're also happy about. You need to understand your investment. Just wholeheartedly, blindly trusting an investment advisor, in my opinion, is never a good idea. You need to know what you're getting into. What does this deal mean? What is structured finance? What is private equity? What is the deal you're getting into? What are the ins and outs of it? If you can't explain it to someone, you shouldn't be in it. So, it's all kind of about understanding what you want to do, where you want to go, how you want to do it, who you're going to do it with, what the risks are, and then what the actual investment is. So all those factors can severely, severely chop down your risk just through a better understanding of what you're getting yourself into.
Thank you, Nate. That was both
Sure.
insightful and interesting. We do have a few questions from our audience, so I'll ask you those now.
Sure.
The first question is, of that 70% of GDP growth that you mentioned earlier coming from emerging markets, how
Yes.
much of it came just from Latin America?
It was about 30% just from Latin America. Asia's huge, and then Africa is certain parts are growing, but certain parts of Nigeria is growing, Egypt, but the rest of Africa is quite nothing. So Latin America is the smaller chunk, Asia is a bigger chunk, and then Africa.
Mm-hmm. The next question is regarding growth rates. So this particular audience member is finding it hard to believe that Latin America will continue growing at 5% in 2013. Brazil's on track for maybe 1%. Mexico is better, but can Chile and Peru really carry the continent?
That is a really good question. It can't. We're looking at Colombia and Peru, possibly Panama for the highest growth rates. Chile's growth rate is stable just because of the stability of the country, and it's already kind of where it needs to be. Brazil has slowed down, and it depends on the Chinese market a bit. But right now, for huge growth, we're looking at Colombia and Peru as our two favorite regions, with a significant amount of money coming in. I know the ex-presidente of Colombia, Uribe, he's been on the kind of warpath for the past couple of years, really promoting the feasibility of investing and doing business in Colombia. The one thing I love about Colombia is it has incredible fundamentals, but it suffers from a PR problem. So if you look at Argentina or other countries, they have horrible fundamentals, but no PR problem. My point being that lots of people they default to Escobar, cocaine, and violence when they think about Colombia, whereas the crime rate in Bogota is lower than the crime rate in Philadelphia. So Peru and Colombia really are our growth drivers, and Mexico are where we think are going to carry not really carry the entire continent because Brazil is just so large, but those are the three main drivers for growth in the region. Also, an establishment called the MILA, the Mercado Integrado Latinoamericano, the integrated market of Latin America, has been slated for design for the past couple of years and is coming together. And basically, it's going to be a combined stock market of Brazil, Peru, Colombia, and Chile. And so that's going to be huge for the region in terms of increasing liquidity, getting more investment in, getting more products out.
So our next question is about a particular type of investment. What are the considerations if you're going to invest in telecommunications infrastructure?
Ooh, well, telecommunications is a big one. And also it kind of gets broken down into telecommunications slash kind of tech almost. One of the things we've covered and we think is very interesting is mobile payments, which is a huge thing in Latin America, just because you can use mobile payments similar to credit cards in a country that doesn't, or in a region that doesn't have many credit cards. So you can put credits on your phone and use that to buy whatever you want. You can charge it up. So mobile payments is a huge facility. And also there's kind of a jump actually happening in Latin America where, for example, I was in an island off the coast of Panama, and I could pay for my hotel with PayPal, but not a credit card, because they didn't have a hard phone line, but they had internet. So when you're looking at telecommunications, you kind of have to do a little more projections on what is going to be needed in the region. Where is going to be, where not what's happening really now, where do you need BlackBerry, where's going to have higher BlackBerry penetration, iPhone penetration, 4G, 3G, so on and so forth. But another thing that's kind of important to look at telecommunications is in most cases, they have a huge government involvement. So there's a lot of government which is difficult to work with in terms of working directly with telecommunications. However, they are listed stocks, so you can get exposure that way. So telecommunications is one thing, mitigating the risk of dealing with the government, to looking at where things are going to go. Who's going to, what's the next mobile thing that is going to be out there and people are going to need? Is it going to be, what's the next cell phone? What's the next kind of cell phone? What's the next kind of internet wireless coverage? So on and so forth. So as Latin America, like I said, this also has a huge correlation with what we discussed earlier in terms of the growth of middle class. People have more disposable income these days, and they want more stuff. I mean, humans are consumers. And so what are they going to want to have when they have this more money? Are they going to want, better cell phone service, fancier cell phones, so on and so forth? So that's really going to be a driver for telecommunications. But as the country grows, or as the region grows, and as this wealth, the disposable income goes up, there's going to need to be more telecommunication infrastructure as the populations are going farther, moving farther. Think about kind of Los Angeles 100 years ago than Los Angeles today. It's just spread ridiculous. I mean, it's urban sprawl. So things are going to sprawl across Latin America and giving rise to the need for greater telecommunication services. You're going to have cell towers in more places. You're going to have broadband in more places, fiber optics, so on and so forth. Another thing that's interesting to look at with telecommunications is the fact that since Latin America is a little behind the developed world, or is in terms of technology, it benefits from not having to develop in this technology. So Latin America doesn't have to create or invent or spend research and development money on anything. It just needs to implement technology used in the developed world. So fiber optic cables, better cell service, so on and so forth. There's 4G services has all been developed in other regions. Latin America is just waiting for the need before they can create the supply. So that's going to really benefit Latin America in terms of their kind of earnings per share, because they need to spend less than, say, AT&T, but they will make the same amount because they will be providing the same services. So that's also another thing that's interesting to look at when looking at technology or telecommunications.
What about opportunities for direct investment?
Direct investment, in my opinion, is the most interesting way. And it's definitely the most risky, but I think it has the highest reward, and it's the one that requires you have to be most hands-on. So again, I mean, there's many opportunities for direct investment across Latin America, whether it be private equity, in land ownership, commodities. In private, we're excited about this development of alternative asset classes. If you look at private equity, because private equity is starting to grow in Latin America. So, Advent, Carlyle, so on and forth. Some of the big guys are putting money in, but even smaller players are putting money in. But what happens is when you take this company, XYZ company, you give it some structured management, you infuse it with some cash, you run it for a couple of years, your exit is an IPO. That IPO is going to create a more robust stock market in that region. It's going to create more liquidity, more cash. So direct investment is fantastic. Also, in my opinion, real estate is always a good idea. I mean, obviously, there's sometimes it's not, depending on the country, but real estate is solid, is tangible. People like real estate, and in Latin America, there's very little lending. There's no mortgage market. When I was in Argentina in 2008, they said "qué crisis?" Like, what crisis? Because they had already lost everything in 2001. Now there's no mortgages. That nothing really happened to them. So, and also if you look at the build quality in Latin America, most houses in Buenos Aires you could hit with a tank and the tank would break. So, I mean, real estate is a solid investment, and as things begin to grow, there's opportunities now for getting in before people have all gotten there. I mean, Brazil has priced itself out of the market in the past 5 years. Before that, you could kind of get things. In 2000, also this also looks at crisis investing. In 2001, in Argentina, you could buy amazing palatial apartments for very little money, for under 100 grand. You could buy, large buildings, lots, so on and so forth. So looking at downturn economies is something to consider when looking at foreign direct investment. Venezuela is super risky right now, but if you look at the spread, the official exchange rate is 4 to 1. The unofficial is 13 to 1. That creates opportunities. But you have to see, is that opportunity worth the risk? Is Chavez going to kick the bucket? Who's going to come in next? Is it going to be another leftist? Could be right. Where are you going to put money? Also, if you can look at, let's take Venezuela for example. If you were going to buy, if you looked at like the state of Merida in the west of Venezuela, that's a very anti-Chavez region. That kind of provides a little more security, in my opinion. But it really depends on what's going to happen politically. Other direct investments, land, obviously, private equity, renewable energy is huge in Latin America. Brazil has 96% of their electricity grid coming from renewable energy sources. They have wind power, solar power. They've developed jatropha, which is a non-feedstock. You can't eat it, but you can use it to make ethanol. So renewable energy is huge. The only problem with renewable energy is it's a really long play. You're not going to get your money back for a long time. But if you're looking to diversify over time, asset protection, lock up some cash somewhere, renewable energy is fantastic, it's sustainable. And we're big fans of renewable energy. Also, I mean, something that people don't really consider as an investment vehicle, but we consider it is art. Art is a phenomenal place to put money, especially Latin American art. In the early 90s, you could pick up a Frida Kahlo for around 30 grand. The last Sotheby's auction, Frida Kahlo went for upwards of 10 million. So, I mean, art hasn't lost money in quite some time. There's actually a new acronym that came out of Goldman Sachs called SWAG, and now it's kind of the second version of the BRICS. But SWAG means silver, wine, art, and gold, as none of those asset classes have dropped in the past 5 years. So art is another one that people are starting to look at. There's a fellow quite a wealthy guy in Venezuela. He's worth about $4 billion. He's got about 1.7 just in art, because it's how he's protected his assets. He calls it asset protection. He also really likes art. But yeah, foreign direct investment is the way to both to maximize your gains in terms of investment, and also, in my opinion, really contribute to the economy in which you're investing. I think foreign direct investment, in my opinion, is fantastic. It's a win-win. The place, the country, the region wins, and the investor wins if it's done correctly.
Our next question is about the legal systems in Latin America. How do you assess your confidence in a country's legal system when making investments in Latin America, especially in the enforceability of contracts?
True. Okay, excellent question. I mentioned something earlier called the Heritage Index of Economic Freedom. This is a fantastic resource for people looking at investing basically anywhere. And what this index does is it takes into consideration a lot of factors. It takes in time to complete a contract, time to hire someone, fire someone, time for a contract to be filed, taxation, all the indicators you need to do business in a country. It rates them all and gives a country a score. So for example, Chile is number 7 in the world. The USA is number 10. So Chile is much easier to do business than the US. Hong Kong's always number 1 because they're Hong Kong. But then if you look at, say, Venezuela is 174. It's 3 up from North Korea. Argentina is 100, which is considered mostly unfree. So Brazil is somewhere after 100. But so that's one of the things to look at. But the legal system is a tricky proposition when looking at Latin America. So one of the best ways to go about it is to look at hiring multinational firms within the region. Look at the Baker McKenzie's or whoever has the offices in the region. when I worked in China, the larger international firms kind of had a crisis of conscience because the way China works is a little bit different. And so they didn't know whether it was better to win for their clients or to play the Chinese game and just bribe the local judge. It's a difficult thing to do when you're in these markets, but you're based in the U.S. So that's the best way to go about things, in my opinion, is find the mix of the local partner and the country you're coming from. So from Spain, find a Spanish law firm and wherever, or so on and so forth. So finding someone that plays in both fields or has a foot in both court, that's a really useful way to go about the legal situation. Because if you're just dropped in a country, you don't know what's what. You don't know who's giving you the correct information, who's giving you the wrong information. Just from experience living in Argentina, I've had 30 different answers on how to get a business started in Argentina, or how to become a corporation, or how to get a business visa. Everyone has a different opinion. So really, to go with someone who's both in the industry and is also multinational, has their foot in different regions, and knows how to do business, that, in my opinion, is the best way to go, despite the fact it will be considerably more expensive than going with a local player.
Nate, could you repeat the name of that index one more time that you mentioned?
Oh, the Heritage Freedom of Business Index.
Great, thank you.
I believe go ahead.
No, you go ahead.
Oh, no, I just believe it's a Wall Street Journal funds it, I believe, but it's an NGO that just is pure information. They're based out of D.C.
Mm-hmm. So, Nate, you've mentioned that you like Peru and Colombia in the Andean region. But what are your thoughts on Ecuador for potential investment?
Ecuador is a strange place. It's been traditionally considered fairly left, and one of the main drivers in Ecuador is or the main growth regions or regions, the only real place I see for investment is in tourism and in hospitality, because it's a beautiful place to visit. Plus, put into consideration the Galapagos, and that's a huge, a main moneymaker for Ecuador. Outside hospitality, tourism, ecotourism, we're not super bullish on Ecuador. It's a very interesting place, nice place to visit. But again, for us, the hospitality angle is really the only way to go. So if you're looking at, if you can bring something new to the table, what does Ecuador not have that you think it needs? Is it, like eco-friendly hotels with solar panels or whatnot? Is it boutique hotels? Is it more specialized package tours? One thing that we found very interesting in Argentina, which could be applicable to the hospitality and tourism model in anywhere really, but specifically to the question of Ecuador, is again going back to this growth of middle class and people having more disposable income. What they saw in Argentina was non-traditional tourism. So there was more tours coming from China, from the Middle East, from India. However, what wasn't done was a way to cater to these people. So what one of my associates were looking at was doing tours catering to non-traditional tourists. So say, for example, an Indian group, they're not going to eat beef in Argentina. They want a certain kind of food. They want a person who speaks Hindi or whatever. So you can do these tours, which is a new growth industry which didn't exist before. Think about having a tour to the Galapagos where all the tour guides speak Chinese, you have Chinese food, you have Chinese booze, so on and so forth. That's a new industry that didn't exist 10 years ago, which is something people can capitalize on. So I think tailor-made services to the nouveau riche is an excellent opportunity moving forward, and especially for a country as tourism-centric as Ecuador.
Our next question is regarding real estate in Brazil. You mentioned that it is kind of being priced out of the market, and this audience member believes that may be true in Sao Paulo and Rio. But what about opportunities in the secondary regions and cities of Brazil?
That's an excellent point. In Sao Paulo, Rio, and in the surrounding areas, the prices are ridiculous. However, if you're looking in the Noroeste, up north, there is a lot of development, good deals availability, and obviously, Brazil is a gigantic country. So there is significant development on the interior, in the Amazonas, in Manaus. There's a lot of things happening. So there is potential. It's just the problem is coming into seeing where the need will be. Where are people going to want to live in next year, 2 years, 5 years? So that prediction is very difficult to make. But there are excellent opportunities for real estate development in the northern region of Brazil, both for tourism, residential, and business. We just see that development in other places are getting better just because of the proximity of the U.S. and cheaper prices. Also, like I said about that we discussed earlier, perceived risk. Like as I said, that things are getting priced out of the market, but people are perceiving that the prices are very high and not going there, which is keeping the market stagnant. So in the Noroeste region, there's definitely room for development, but again, it has to be based on accurate projections of what people are going to want. Are people Paulistas, are they going to be moving up, getting second homes up north on the beach, or are they going to be second homes for tourist vacation? Are there going to be new central business districts developed? Is there, say if Apple puts a factory out there somewhere, is there going to be a diaspora of people, coming into the region or leaving the region? What's going to happen that's going to make that a hotspot? Obviously the main goal of any investor is to get in before the getting's good, just before that. So that's the hard thing about Brazil, is to see where it's going to be, because it is so centered around Sao Paulo and Rio.
Great, thanks. Our next question is, how can an individual investor go about investing in the Colombian market?
Depending on the size of that individual investor, I'm like a private investor, that it depends on how much exposure you want. There's a lot of private equity funds, Andean funds. Those are the best way to get exposure with the top talent. There's several private equity funds which have excellent managers, excellent track records. They've been growing rapidly. They do quite well in terms of giving exposure directly to Colombian assets and having an excellent track record. They kind of have everything you want. A manager you trust in a region you want to be in, and the due diligence you can do is minimal. Other than that, going into Colombian equities, Colombian property. Property. There's a town called Santa Marta, which is just south of Cartagena. It's a beautiful place on the beach, amazing little town, and property prices are minimal there. Compared to where else you can get a beautiful house on the beach or a condo on the beach. So, looking at property is an excellent way to get exposure to these markets, and especially in an industry that most, 99% of people understand is in real estate. Also in the fact that, most, bank accounts or CDs in the U.S. or Europe are just losing money. We're being beaten by inflation. So, real estate is an excellent way to get money in, either for a second home, for rental property, buying condos that aren't built yet, buying land. But obviously in real estate, you're going to need a lot more due diligence than you are with a fund. A fund, you're going to be able to check the track record, talk to some old clients, and it'll be pretty easy to figure out. Real estate, depending on what you're buying and where, the due diligence process is going to be much more lengthy. It's going to be much more hands-on, but in my opinion, much more rewarding.
Thank you, Nate. The next question is, how does a non-local direct investor get local knowledge to assess the upcoming opportunities?
Right. So, basically it's a matter of making interpersonal connections. So, if I was going to say go into some place that I've never been before and want to invest in, so I'm going to Tajikistan, wherever, or I'm going to, say, Ecuador even, wherever I'm going, first of all is you got to figure out what you're going to do. So if say I'm going to Ecuador to do real estate, I'm going to Quito to do commercial real estate, I want to set up some meetings with some people who know the industry. So talk to C.V. Richard Ellis or Jones Lang LaSalle or some of the international players. Take the MD out to lunch, whatever. People are very friendly in Latin America and like lunch. Well, people like lunch everywhere. But anyway, talking to people and getting the inside knowledge first before you go to you need to go to the region if you're going to do it. So first, make out some connections through LinkedIn, through emails. People are very, very open to talk about the region. If you go to invest in the country they're working, that's good for them. They want investment to come to their country. So reaching out to a person who's an expert in the sector, reaching out to local media, setting up meetings when you're actually there, finding people who are actually doing it. If you're going to do real estate, if you're going to buy a second home that you're going to rent out, go to RE/MAX, go to Century 21, go to the rental agencies, ask them, what is your occupancy rates? How has the rental rates declined, increased? How much money are you making? How long has it been vacant? So get some background just by finding the informational kind of network that surrounds the industry you're going into. If it's private equity, who are the custodial banks? Who are the private equity funds? Who does the due diligence for them? Who are their auditors? Talk to KPMG in these regions. Talk to Accenture. There's international companies that have presences everywhere. Boston Consulting Group is an excellent resource. People are willing to talk to you if you have questions. So if you get enough information, and you start seeing replication in that information. If the contact 1 said the same thing as contact 3 and contact 7, that's probably correct information. If they all come from different places, so you can really get an idea of what people are thinking on the ground and how they think about that sector, if they think it's a good idea, a bad idea, whatever. But just really, it's kind of the shotgun approach. Just kind of put your question out there to whoever is relevant, and especially this has gotten much easier, in the past decade with obviously internet technology. I mean, with LinkedIn, with Facebook, with Twitter, with whichever, you can really quickly connect with people and set up interpersonal relationships, meet them, and get a good idea of what's going on. Whereas 20 years ago, it would have been a lot more difficult.
Thanks, Nate. Those are all the questions we have from our audience. So as we draw to the close of our presentation, I would like to say thank you for everyone who has joined us today. I hope that this webinar has been an informative look into the world of investing in Latin America. And a very big thank you to you, Nate, for being a panelist today.
It was my pleasure. Thank you so much, Kristen, for having me.
Thanks. Additionally, if you're interested in staying up to date on similar written content and events from Axial Market, including our upcoming webinar on best practices for M&A deal integration, please sign up for alerts on our events page found at the URL shown on your screen. Have a great day, everyone. Thanks.
Thank you.